If you hold XRP, XLM, Bitcoin, Ethereum, or any other altcoin, in this video, I'm going to be explaining how massive institutions will be entering the market this coming bull run. And some people are even saying that they are entering right now silently without anyone knowing. And in this video, I'm going to be explaining how these massive institutions enter the market with large orders without moving the price through what's called dark pools, OTC deals, and more importantly, how you can prepare before the tsunami of money flows in when these spot Bitcoin ETFs are approved by the SEC. So comment 777 if you're feeling blessed, comment 777 if you're feeling bullish, and if you're going to become the first millionaire in your family tree, you know what to do. Confirm it by tapping that subscribe button, tapping that like button, and let's run it. All right, bull runners, welcome back to the channel. So let's talk about how institutions enter the market without anyone knowing. Number one, the first thing we need to discuss is OTC, or over-the-counter trading. So how this works is institutions, they use what's called OTC desks to execute large trades privately, and OTC trading doesn't impact the open market prices as trades are settled off exchange. And if you're just a regular retail investor, which is like 99% of us, I mean, if you're not trading with, $100,000, $500,000, or $1 million or more, you're an everyday retail trader. And don't look at that as a bad thing. This gives you something to start from so you can start growing to the point where then you could start doing OTC deals. But it's good to know about these beforehand. So how it works is institutional clients, they contact an OTC desk, and it's often operated by cryptocurrency exchanges or specialized OTC brokers. So some popular OTC desks would be companies like Genesis Trading and Goldman Sachs-backed Circle, and they have a principal OTC desk called Circle Trade with a minimum entry point of $250,000. And I know if you're thinking, well, how does this affect me? Pay attention, because I'm going to be talking about liquidity pools in this video. I'm going to be talking about slippage. I'm going to be talking about front-running artificial intelligence trading bots and how those affect the market as well too. So you're going to gain a lot of information in this video that you guys need to know. And how it works is the institutions, they discuss the trading requirements, including the desired quantity of tokens or coins that they want. So if they're buying Bitcoin or XRP or Ethereum or Quant or HBAR or Algorand or anything else, and they have specific conditions with the OTC desk. So the desk provides a quote for the trade, based on the current market conditions, the current market price, and this price is often slightly different from the public exchange price. So if you're looking on like Coinbase or Crypto.com or Poloniex or Kraken or Binance, well, this price, would be offered at a better deal for convenience and privacy offered by the OTC trading service. So they get, a better pricing for a bulk order. And once both parties, agree on the terms, a trade agreement is reached and the trade is executed. So how this works is the trade is settled off of centralized exchanges, meaning it doesn't impact the public order book. So this can involve a transfer of, cryptocurrency and fiat currency between the institution and the OTC desk. And OTC trades are typically confidential, so they don't influence market sentiment or prices until after the trade has been completed. And I'll explain why this matters, because OTC desks typically require a minimum trade size, which can vary significantly depending on the provider, depending on how much money the institution has, whether they want to move just a few $100,000 or millions of dollars. And some cryptocurrency exchanges even offer dark pool services where large orders can be executed anonymously. So they don't have to reveal their identity to the public, and they don't have to have their wallets tracked, and minimizing their impact on the public order books, through like Coinbase or Crypto.com. So when institutional or high net worth investors want to buy or sell a substantial amount of cryptocurrency, they might hesitate to execute these orders on public exchanges because large orders significantly impact market prices, causing them to rise or fall rapidly, so they don't get the same price for a large, order. So dark pools offer a level of secrecy for traders. In traditional public exchanges, large orders can be visible to other traders, and there's big problems with this. One of the biggest ones is what's called front running, and that's where other traders, trade ahead of the large orders, or, the price manipulation that takes place, because in dark pools, the identities of the investors and the details of their orders are often hidden from other traders until the trade is executed, so they don't lose money. Now, a big issue with front running on decentralized exchanges like Uniswap or PancakeSwap is when AI trading softwares, what they do is there's a thing called lag time between the order filling. So for example, if you're going to go on Uniswap and you want to trade like $10,000 worth of Ethereum for $10,000 worth of Uniswap or something like that. Well, when you place that order, that lag time between when that trade fills is when artificial intelligence bots come in and then they buy it before you do. So the price spikes up. So your order is filling at a higher price, and then they sell on you. And so you're losing money on that. And so there's tons of these artificial intelligence softwares that are executing that. So dark pools and OTC deals don't allow that to happen. So by executing large orders in a dark pool, what traders can minimize is the impact on the broader market, and they avoid front-running artificial intelligent trading bots. So if a large buy order were placed on a public exchange, it would drive up prices before the order is fully executed, resulting in higher costs for the buyer as the order fills in chunks. Because imagine if you're coming to Coinbase or Coinbase Pro or crypto.com with $100,000, well, in order to fulfill a buy order, there have to be sellers that you're buying from. And most sellers aren't selling $100,000 at a time. They're selling like $50, $500, $2,000, $75. So there's all these sell orders at different prices. And so if you're placing a chunky $100,000 market buy order, meaning that you're buying at whatever the market price is, well, it's going to buy up everything, and you're getting price points that are all over the place. So imagine if you're going to a garage sale and you see a table with 100 t-shirts on it, ranging anywhere from $5 a t-shirt all the way up to $100 a t-shirt, and you're just going to buy all those t-shirts. Well, you would have a dollar cost average on what you're spending across all the t-shirts, where you take the total amount you spend divided by the total t-shirts, and that gives you your dollar cost average. Now in crypto, it's somewhat similar. Obviously, there's some key differences. If you place a large order on a public exchange, it would drive up prices before the order is fully executed, resulting in higher costs for a buyer as orders fill in chunks. So it's not like you're buying t-shirts, because crypto's more volatile, obviously. And what dark pools do is they match the buyers with the sellers within the pool, but the details of those matches are typically not disclosed to the broader market until after the trade has been completed, which prevents AI from losing them money. So cryptocurrency exchanges, in addition to their regular public order books, offer dark pool services as a separate trading venue within their platform. And dark pools often benefit like reduced slippage. They benefit these traders through reduced slippage, large orders, and privacy for traders. And slippage, what this refers to, is the difference between the expected price of a trade and the actual executed price of the trade. And it occurs when the market moves between the time when the trader places an order and when the order is actually filled. So here's how slippage works so you can better understand it. So let's say you're the trader, you decide to buy or sell a cryptocurrency at a specific price known as the limit price. And so for example, you might set a limit buy order for Bitcoin at, let's just say $50,000, even though right now at the time I shoot this video, Bitcoin's less than that. Let's say you were buying at the top of the market. So the crypto market, because it's highly volatile and it can change rapidly, by the time your order reaches the exchange and it's matched with a counterparty, the market price may have already moved. Bitcoin might be at $55,000. So the trade is executed at the current market price, which might be different from your specific limit price if you place a market buy order at whatever the market price is. So if the market price is now higher than the limit price for a buy order or lower than the limit price for a sell order, then slippage occurs. Now the difference between the executed price, which would be in this case the limit price of $50,000, and the actual executed price is the slippage. And so it can result in you paying more than anticipated for a buy order or receiving less for a sell order. That's why it's important, if you're using a decentralized exchange like Uniswap or PancakeSwap to trade altcoins, is you need to look at the slippage percentage so you don't lose more money. A lot of traders just go in there and they load up $500 worth of Ethereum or $1,000, and they just buy any altcoin without paying attention to the advanced or the gear icon to see what the slippage percentage is. And there's a way that you can set the max slippage percentage that you will be willing to allow for any trade on Uniswap or PancakeSwap. And a decentralized exchange like Uniswap, they operate on what's called an automated market maker, or an AMM model. So this is important to know as well, because liquidity pools are at the core of this automated market maker system. And these pools, as complicated as they might seem, it's really simple. They consist of pairs of cryptocurrencies like Ethereum to an altcoin. It would be like Ethereum to Chainlink, or Ethereum to XRP, or Ethereum to Bitcoin, wrapped Bitcoin, or Ethereum to Uniswap, where users provide their assets in exchange for trading, where they earn fees from the liquidity pool. So the liquidity pool contains a reserve of both currencies in the pair. So what traders would do is they would swap one asset for another by trading with the pool, and the price is determined by the ratio of assets in the pool. So the larger the liquidity pool, just simply meaning more money that's put up of Ethereum, more money that's put up of Chainlink in this case, if you're going to trade to Chainlink or XRP or XLM, any altcoin, the lower the potential for significant price changes or slippage, because a larger pool can absorb larger trades without affecting the price as much. So the lower the slippage percentage, what that means is the larger the liquidity pool generally is between the trading pairs that you're trading, whether it's Ethereum, USDC, USDT, or any altcoin. So you have to be careful if you're dealing with newer projects and newer altcoins with smaller liquidity pools, because if the liquidity is pulled out of the pool, then you won't be able to sell because there's no liquidity and you're left holding the bag. And so you can use something like DEX tools. You can check the liquidity of a project and you can see how much is in it before you consider buying or selling. And as always, it's not financial advice. Don't buy or sell anything mentioned on this channel. This is purely for educational purposes only. But another thing that you can look at is market cap. Market cap is a measure of the total value of the cryptocurrency, and how it's calculated is by multiplying the current price of the cryptocurrency by the total number of coins that are in circulation. This is different from max supply. You have to look at the coins in circulation. So a cryptocurrency with a higher market cap typically has more trading volume and liquidity. So that means that larger cryptocurrencies with higher market cap tend to have lower slippage when traded against other assets because they have deeper liquidity pools. And the number of holders of a cryptocurrency can also influence its liquidity and consequently its slippage. So if you use Etherscan or BNB scan, you can check a project and you can see how many holders there are of that project. So if a cryptocurrency is held by a larger number of people, there is a higher likelihood of a liquid market because there are more potential buyers and more potential sellers. And cryptocurrencies with a larger user base, tend to have lower slippage because there's a higher likelihood of matching the orders with the existing liquidity pool between buyers and sellers. So when using decentralized exchanges, Uniswap might come to mind, PancakeSwap might come to mind. You guys can comment other ones below. You can set your maximum acceptable slippage percentage that you would allow. And this is the maximum difference you are willing to accept between the expected and the executed prices based on volatility. So if you set, let's say, a 10% slippage allowance and a project is sitting, at $10 per token, well, if the project within the time of trying to execute the order jumped up to 12 cents, well, then it wouldn't fulfill that order because 12 cents compared to 10 cents, the slippage is 20% and you set it to 10%. So if you set a 10% slippage and it fluctuates by 20%, it's not going to fulfill your buy order. So that's super important, right? To strike a balance when setting this percentage, because, if it's set too low, then the trade may not be executed and you might miss out as a project is, rallying to the upside, because the market can move very, very quickly, especially during the bull run. Now, if it's set too high, or if you don't even check it at all, you risk significant slippage and you might not get the price you expect due to front-running bots, and you might be buying the top when a project is retracing, and then you might be sitting on a project for months at a time holding the bag. Now, if you go on coinmarketcap.com, you can click on any altcoin and you can click on what's called markets to see which exchanges this altcoin is trading on. And if you look at the volume within the past 24 hours, this will give you an idea of how large the liquidity is, better than most platforms. And when you're pairing it with another token, you'll see which pair has the most liquidity in the pool. For example, you can see a project like Chainlink to USDT, which is Tether's stablecoin, has over $21 million in trading volume the past 24 hours on Binance, which means the liquidity pool for Link to USDT is absolutely massive. So the slippage would be low when placing an order. So what these institutions do, instead of placing a single large massive order, is they stagger orders at different price levels to dollar cost average in and out of the market. So if you want to prepare for the next market, you're not just going to take your entire paycheck and just dump it into one project at one time. you would dollar cost average on the way down and on the way up. And you can dollar cost average in and you can dollar cost average out of the markets. And what these institutions are about to do is going to be 1,000 times bigger than anyone could ever imagine based on the last bull runs. And here's why. So BlackRock, the company that owns the media, and they virtually own the world. They have trillions of dollars assets under management. They became the first Wall Street giant to use JP Morgan's blockchain-based collateral settlement system, which is part of a plan that BlackRock's chief executive has said will usher in the next generation for the markets. And last week, JP Morgan's Ethereum-based Onyx blockchain and the bank's tokenized collateral network were used by BlackRock to tokenize shares in one of its money market funds, sending them to the London-based Barclays in an over-the-counter derivatives trade. Now, I know that might seem complicated, but what this means is this blockchain technology allows traditional assets to be what's called tokenized on a public ledger on the blockchain, potentially making the transfer of anything from stocks, bonds, real estate, and alternative investments like art cheaper, easier, and more liquid. So imagine if they tokenize these massive industries and bring just 10% of each market to blockchain, to the cryptocurrency industry. Look at the global stock market. Somewhere close to $100 trillion in 2021. What is it at now? I mean, it's got to be somewhere up there of 70, 80, 90, $100 trillion. So 10% of 100 trillion would be about $10 trillion. Imagine that in crypto. The crypto market is only at 1 trillion right now. So imagine the total value of global real estate tokenized, including residential, commercial, industrial, and agricultural properties. That's well above $100 trillion. And in 2021, that was over $200 to $250 trillion. So take 10% of that. That's another $10 to $20 trillion in the markets. And look at the foreign exchange market. It reached $7.5 trillion per day. In April of 2022. We're not talking about per year, we're talking about per day. The FX market is the largest market out there next to, you look at derivatives as well too. So imagine just a fraction of all of that running through something like the XRP ledger. Even if just, for example, 1%, this is pure speculation here, this is not a guarantee obviously, but just imagine if 1% of the FX market, the $7.5 trillion per day foreign exchange market ran through the XRP ledger. Well, that's $75 billion per day. And XRP's current market cap, to put this in perspective, is only $26 billion total. $26 billion, that's it. So can you see why this is a big deal to start learning about blockchain, to start learning about the crypto industry right now? Because last year, BlackRock's chief executive officer, Larry Fink, he called the technology very important, writing in his annual letter to shareholders that very interesting developments are happening in the digital asset space. And he's akin Bitcoin to the digital gold. And so, you know what that means? When Bitcoin rises, the tide rises, so do all ships. And based on percentage gains, it's obviously, in my opinion, I hold some Bitcoin, so it's smart to hold some Bitcoin. I'm not telling you what to do. That's up to you. You got to do your own research. But the percentage gains for projects like XRP, XLM, VeChain, Chainlink, Algorand, HBAR, other massive projects, I believe have a higher upside because the market cap is a lot smaller than Bitcoin's 500 billion. XRP is only 26 billion right now. And so the best way to prepare, if you go to bullrunners.com, we're about to launch our financial education platform to give you guys the best information to help you make money in these markets without any crypto trading experience. So by watching this video, if you're still confused on all this stuff, you don't need to understand all of the terminology. In fact, I'm still understanding and learning stuff every single day. So I encourage you to subscribe to the channel, like this video, join our community, go to bullrunners.com to be notified first when we launch our platform so you can be able to earn more income online. And if you want to see the altcoin list of what we're holding for this next up and coming bull run on what we're bullish on, then you'll be the first to be notified on bullrunners.com. Because as always, what we're doing is we're backing up our trucks all the way to the bank, beep, 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 boom, backing it into the bank, grabbing the bags, packing them and stacking them, leaving no bags left behind because we believe that the spending power of the dollar is going to continue to go down in value. That's a fact based on inflation. Blockchain technology, distributed ledger technology is going up in interest. The institutions are about to start dumping a massive amount of money into these markets the next 5 to 10 years, and you have to be ready because together we're all going camping on the beaches of the moon, my friend. I will see you on the next video. I will see you on bullrunners.com. As always, you know what to do. Stay bullish.